All right, let's talk about the new great game playing out across Africa. It's basically a railroad war. China's pumping billions into these massive railway projects. But here's the thing, they aren't just about getting from point A to point B. We're going to uncover why these lines, which often lose a ton of money, are actually critical pawns in a global chess match for resources and, you guessed it, influence. So our story really kicks off with a move that kind of stunned a lot of analysts. In late 2025, out of nowhere, Beijing decided to revive the Tazara Railway. Now, this was a project from the Mao era that had pretty much been left to rust for decades. So why would they resurrect a ghost of the past? Well, it's because a brand new rival just showed up to the game. And look, this wasn't just about a fresh coat of paint. We're talking about a massive agreement to completely modernize the entire Tazara line. This begs a really important question. Why on earth would you pour $1 billion into a railway that has been losing money for 50 years straight? To get Beijing's logic, we actually need to look at another, much more modern railway and the tough lessons it's teaching everyone. To see what might be in store for the old Tazara line, we've got to look at a recent super high-profile example. It's a railway that really pulls back the curtain on the true cost of these projects, long after all the ribbon-cutting ceremonies are over. So our case study is Kenya's Standard Gauge Railway, or the SGR. It is one of the most ambitious projects in East Africa, and it's a perfect window into the big promises and, yeah, the hidden costs of China's railway strategy. I mean, just look at the speed of this rollout. They broke ground in 2015, and just 2 years later, they had passenger and freight trains up and running. And then they just kept expanding from there. The scale was absolutely immense, and the execution was incredibly fast. It really did fundamentally change the connection between Kenya's port city of Mombasa and its capital, Nairobi. And this was never just about laying down some track. The SGR was a cornerstone of Kenya Vision 2030, which is the country's huge national development plan. It was pitched as a key driver for the entire economy, the foundation you need to unlock massive economic growth. For the average person, the SGR has been a total game changer. The trip between Mombasa and Nairobi was literally cut in half. It was safer, it was way more reliable, and it was more affordable. This public goodwill is a key part of the strategy, but it's only one side of the balance sheet. Right, so that incredible passenger experience is only half the story. The moment you look past those gleaming passenger cars and start digging into the balance sheets and the freight yards, a much more complicated picture starts to come into focus. And here's the central problem. While passengers were celebrating, the freight side, the part that was supposed to be the real economic engine, it's been sputtering. Costs stayed high, but even more importantly, the Kenyan government was locked into these take-or-pay contracts. This basically forced it to subsidize the Chinese operator even when cargo targets weren't being met. And when researchers started asking those tough financial questions, they were met with a total wall of silence. The project's viability became a sensitive topic. That reluctance to even talk about the numbers is pretty telling. It really suggests the answers aren't nearly as good as the passenger experience. And this isn't just some accounting issue in a vacuum. These financial questions are coming up while Kenya is grappling with some really significant national debt. A multi-billion-dollar project that can't pay for itself quickly becomes a major burden on the entire country. So this brings us right to the core of China's whole strategy. If the railway doesn't actually make money, how can it be a success? Well, this is where we see the strategic subsidy model in action. You accept financial losses on the ground in exchange for a different and, frankly, more valuable currency. The research frames this perfectly. It borrows a term from Kenya's original colonial railway, the Lunatic Express. So is this new SGR a similar mistake, a financially reckless project, or is it something more, a mega project whose true impact you can't just measure in ticket sales? For the project's backers, the answer is crystal clear. The SGR's value isn't measured on a profit and loss statement. Nope. It's measured in diplomatic loyalty at the UN and getting first dibs on crucial resources. That is the real return on investment. So you end up with these two competing truths living side by side. It's a modern transport artery that is also a financial black hole. And this really reveals the core principle. For these projects, success isn't defined by profit. It's defined by their power to advance a nation's strategic goals, both at home and on the world stage. And this quote just says it all, doesn't it? The SGR is this powerful symbol of progress. It represents a nation's ambition. And that symbolism is exactly what China is investing in. They're creating allies who see Beijing as their #1 partner in development. And that brings us all the way back to the Tazara Railway. The lessons from Kenya's SGR show us the playbook. As the US-backed Lobito corridor starts rising in the west, China is rebooting its old railway in the east. The race is officially on for the copper and cobalt of the Congo. So the question isn't just whether these are businesses or nation-building tools. The question is, who will win the right to build the future of Africa, and on whose terms?